Welcome to this week's Fed Watch. This is December 29th. This is our last Fed Watch of the year. It's been a quiet week for most businesses, and that's true of the Fed. It's been very quiet with nary a peep out of them over the last week. That doesn't mean we haven't gotten some data in. I want to touch upon four of those data points. One is jobless claims. You may have read came in above economists' expectations. I don't know anything about their expectations, but I can tell you that we are in a 12-month moving average rising trend for initial claims for unemployment insurance at the state level. It's a milder than average rise over the last 10 months, but it is within the parameters of normal. And what's good for all of us who want to avoid a severe recession is that the trend dynamics so far are very much like what we saw in the mid-'80s and the mid-'90s. And neither of those cycles turned into very bearish deals. They showed up more in industrial production than they did in GDP, which is what we're forecasting for 2024. So this is another tip toward the mildness of the overall feel and flavor of the decline in 2024. The second data point I want to touch upon is that overall wage growth, as put out by the Atlanta Fed, continues to moderate. We're down to a 5.2% 112 rate of change. That's data through October. It peaked out at 6.7% last June. So it is indeed coming down. And I expect it's going to come down even further. And that'll make it easier for the Fed to lower interest rates as soon as, probably not as soon as they can, but as soon as they will in 2024. Another little interesting data point, not little in my world, it's a pretty big one, is that the 12/12 rate of change for the M2 measure of the money supply turned up. It's now no longer clearly defined in phase D. It's in phase D, potentially phase A. And the 112 is running above the 12/12, which confirms that we are seeing a rate of change reversal. And I think that's really cool. It's happening at a time when there's been enough restrictions placed on the financial side of our economy that an easing in the rate of decline in the money supply is great. I expect we're going to see more rate of change improvement in the money supply. The acid test is really going to come March and April of 2024. That's when we'd expect to see some sustained ascent in the money supply beginning to take hold. And that's what's going to make it an acid test. If we can get that ascent going in the money supply while the Federal Reserve is modestly lowering interest rates, that's a twofold help for the economy later on in 2024 and in 2025. And the fourth data point I found really interesting this week was Canada retail sales in nominal dollars are growing at a 2.2% clip. That's the 3/12 rate of change. Their inflation's running at 3.6%. So that means real retail sales were a minus 1.4% latest quarter to the year ago, same quarter. So the softening that we're seeing in the US is clearly happening in Canada as well. And we'll see Canada move monetarily along with the United States is our takeaway from that data point. What this all means, to sum it up for you, is we're on track for getting those interest rate declines in 2024. They could come as early as the January 31 meeting. Still think that we're more likely going to hold off until either the March or an April meeting before they start putting those interest rates down. But it still looks like they're going to be coming down. This coming week, starting the new year, we have a lot of good data coming out. We have new orders data coming out. We should be telling the ITR financial leading indicator, the ITR regular leading indicator, construction data, jobs data is all coming out next week. So we'll have a lot more more timely inputs guiding us into what the Fed may be thinking about doing by the end of January. Thank you all for watching Fed Watch this year. On behalf of all of us at ITR Economics, we wish you a very prosperous and healthy new year. Thank you.